Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 124, titled Dividends and After-Hour News Causing Exercise of Out-of-the-Money Call Strikes. We're going to be using a real-life example with Financial Select Sector Spider Fund, which trades on the New York Stock Exchange under the ticker symbol XLF. Let's start off by discussing some of the general reasons why a call option may be exercised. And the main reason is that it's expiring in the money or with intrinsic value. So an example of that would be a stock is trading at 32.50 when the 32 strike was sold, and we're referring now to call strikes. So if that's the case, and we take no action to buy back that call option as expiration is approaching, well, those shares will then be sold at 32. The Options Clearing Corporation will generally, not always, but generally exercise an option if it's in the money by 1 penny or more. So that's a guideline we should go by if we don't want our shares sold. Now, an ex-dividend date is the most common reason for early exercise. So if that ex-dividend date is prior to the expiration of the contract, then that increases the chances of early exercise, although still quite rare. Another reason is simply investor error, and that will happen very, very rarely, but from time to time, and it may be assigned to our account. Now, this podcast will highlight an exception to these reasons. So let's get started. We're going to talk about a real-life trade now with XLF. On 11/24/2020, one of our members purchased 300 shares at $28.59. Immediately after purchasing those shares, the covered call was sold. It was 3 contracts of the 12/18 expiration, so a little less than a month out, for the 29 out-of-the-money calls, 29 higher than the $28.59 purchase price, and that generated a premium of 50 cents per share. Now, on expiration Friday, XLF was trading at $28.52, which was 48 cents below the 29 strike, meaning the 29 strike is out of the money. And since that was the case, no rolling action was executed because we would most assume that that stock or that ETF will not be sold. And so what happens? The Saturday after expiration Friday, the contracts were in fact exercised, and XLF shares were sold at 29. What the heck happened here? Let's first take a look at the initial structuring of this trade on November 24th. The stock was trading, I should say the ETF was trading at $28.59. 29 call was sold at 50 cents. The multiple tab of the BCI calculator shows a return on our option or ROE of 1.7%. Keeping in mind, this is less than a 1-month trade, so pretty nice return, with upside potential of 1.4% if XLF moves from 28.59 up to the 29 strike. So an opportunity here to get about a 3.5-week return of 3.1%. So very nice calculation for the initial structuring of this trade. Now, if we took a look at a 5-day price chart of XLF, right around contract expiration, for those of you who are watching this podcast, you will see the screenshot. Those of you who are just listening, I will describe it for you. So the red circle in the middle of the chart shows that the contracts expired 4 p.m. Eastern time on 12/18, leaving the 29 strike out of the money. It should be no problem. But then we showed a green arrow, which reflects the price moving up when the market opened on Monday, but not to the extent that it opened up after hours, causing the exercise of that 29 call. It never reaches the 29 strike. So on Monday morning, it never got as high as 29, although the after-hour tradings initially did seem to reflect that the price was going to be over 29. The purple circle right at the top of the chart shows that the high price that it was reached on Monday morning was 28.85, still below that 29 strike. What are the explanations for this? Well, there was after-hour news, and that news was an informal news report about Janet Yellen becoming the new Treasury Secretary, and it was initially met quite favorably by the financial community. Now, market makers have up until 5:30 p.m. We, as retail investors, only can do a trading up to 4 p.m. Eastern time. You know that. But market makers can instruct the Options Clearing Corporation to exercise the options up until 5:30. But usually some event would have to happen to motivate them to do that, to exercise what was an out-of-the-money call strike at 4 p.m. Eastern time. It's very rare, but it happens once in a while. Now, XLF happened to have had an ex-dividend date on Monday, 12/21, making Friday a potential target for exercise, because in general, the trading date prior to the ex-dividend date is the most likely candidate for early exercise. So if you don't want your shares sold, if that's critical to your trading, perhaps you own these shares at a very low price point, and there could be some negative tax consequences if you're trading in non-sheltered accounts. Well, you should avoid those ex-dividend dates, only if it's critical to you. For me, I change my portfolio underlyings very frequently. I could care less. Have my stock if you want it. Matter of fact, if it happens early in the contract, I'm even happier if it's exercised early, because then I have the cash back to then use to generate another income stream. But I understand that in some cases, there could be tax issues. So you have to be careful about these ex-dividend dates. So the investor did not capture that 15-cent per share dividend, but obviously enjoyed a hugely successful covered call trade because it maximized the returns from the initial trade structuring. So let's just summarize now. Out-of-the-money call strikes are rarely exercised. I would triple underline that word rarely, but it can happen, and we have to be aware of that. And when they are exercised, after-hour news, like happened in this case with Janet Yellen, and ex-dividend dates, which was also the case with XLF, are two of the more prominent explanations. Now, keep in mind that the date most likely for early exercise is not the X date, but the day prior to the X date. So in this case, the X date was Monday. The date prior to that was Friday. I also want to tell you before we go about our BCI package, our best and most comprehensive educational package ever produced and offered by the blue collar investor. It has 18 components to it, 6 online video courses with downloadable workbooks, 6 calculators developed and created by the blue collar investor and found nowhere else, 5 of our best-selling books on both calls and puts, and that's available in ebook format, and our 13-month annual premium member subscription, which consists of 4 reports of eligible option candidates, along with expanded calculators and many other files and resources, along with our online training program, which consists at this point of over 200 videos. We add 1 new video at least every month. Go to our website, www.thebluecollarinvestor.com, and click on the link BCI Package for more information. If you want to purchase these items individually, you can do so by going to our site, www.thebluecollarinvestor.com/store. The advantage of the package over this is that you get a 25% discount than if these items were purchased individually. But you do have both of those choices. I want to thank you folks very much for taking the time to listen to and or watch this BCI podcast number 124, Dividends and After-Hour News Causing Exercise of Out-of-the-Money Call Strikes. Folks, I hope you enjoyed this presentation, and more importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.